Dollar Tree got slammed on earnings. It's down more than 14% today. Dollar General, which reports tomorrow, followed suit. But it got me thinking about dollars more generally and substitutes for them more specifically. And we're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and welcome to Open Mic, sponsored by OptionPlay, where we try to work through a couple examples of trade ideas together, and I take a few questions as well. As I mentioned, Dollar Tree announced earnings, disappointing results. Among the things that they mentioned was that they're going to be closing 1,000 Dollar Tree and Family Dollar stores. Stock was down more than 14%. We did actually have positions in Dollar Tree and Dollar General, a couple other retailers, Target as well, which I think I had previously mentioned. But as I was thinking about that, I was actually thinking, other than the fact that I wish I'd taken on a bearish posture in these things going into the print, I was actually thinking about dollars more generally, and the fact that our policymakers seem to have almost no ability to rein in their spending. So while everybody is focused, we're going to get PPI data coming up, we're going to get some employment data as well, we're going to get University of Michigan inflation sentiment data as well, we're going to get the FOMC stuff coming out, and then we're going to get the PCE data at the end of the month, which is also very interesting too, because it's slated to be released on Good Friday, which struck me as strange because we have the markets closed, and that seemed very odd. But what it got me thinking about is that if we have no discipline, if we have no fiscal discipline, there's going to be a lot of wood to chop for monetary policymakers, and they might end up getting cornered if any economic data we have turns out to be weak. They're going to be left with some very bad choices. And it got me thinking because, of course, many people are using cryptocurrencies as a proxy, as basically an alternative to holding dollars. And we've seen how well Bitcoin and some others have done this year. And in fact, on CNBC, at the beginning of the year, a lot of the people who are on the air, we were asked to come up with an acronym that represents what we think are the best ideas for the year. Now, of course, the challenge is they ask you basically on January 1st to come up with your acronym. You don't get any chance to amend or adjust your recommendations. But for anybody who didn't see it, my acronym was BRAVE, and the B was for Bitcoin. So why is this important? Because Bitcoin obviously is a haven for people who are concerned about inflationary pressures and basically the depreciation of the dollar that results from it. Many people have been wondering, well, what about precious metals? Because precious metals have historically served that purpose, that if you were betting on inflation, if you were betting that the dollar would be devalued, then a place that you might think to put your money would be in gold, in silver, or in the miners, or the junior miners. So I thought we might take a look at that today. And one of the other things that sort of created some inspiration for this was that I happened to also notice that there was some unusual volume in SLV. SLV is the ETF that tracks silver. So you can obviously trade the commodity, and you could buy the physical, you could buy coins, you could buy futures, you could buy options on futures. But for probably many people who are watching this that don't trade futures or don't trade physical commodities, and I think that probably means most investors don't do these things, there are other mechanisms to do that that in many ways are actually less complex. So I think it's totally fine to trade it that way. I have traded the futures. That's partially because I used to be on the New York Mercantile Exchange, and the NYMEX and the COMEX were the same outfit. We had people with COMEX seats, and they just traded 2 escalator rides up to trade gold, for example. So what was going on in SLV? So we're going to talk a little bit about SLV, and then we're going to talk a little bit about how to play a bullish view in there. Okay, so first of all, SLV typically trades about 220,000 contracts a day, give or take, on average. I'm looking at this. The 20-day average call volume is just under 169 50,000 calls, and the average is about just under 50,000 puts. So call volume significantly outpaces put volume on most days. Traded almost 340,000 calls today. The most active actually were the ones that are expiring at the end of this week, the 23 strike options that expire this Friday. Now that's fine. I just want to make one quick point, which is that a lot of people use options as a way to manage risk effectively on day trades, right? So you can lay out a little bit of money and get some directional leverage to the underlying asset. My view, though, is that while that's a fine activity for people who are day traders, I am not a day trader, so that's not the strategy for me. So what I usually would like to do then is try to take a look at what my longer term view for the underlying asset is. What are things that I want to think about if I'm now going to say that I think that silver could actually catch a bid here at long last? If you look back over the course of the last year, by the way, and let's see here, I've got one month, I think, up here. But if we wanted to just extend this a little bit, go out a little bit further in time to 6 months, what we're going to see is that it actually has pretty much significantly underperformed the market, and we've been stuck in this range for some time. So if we think actually that this might finally be poised to break out, how can we play this? So a couple things to think about. We can play SLV, which is the silver ETF. We could play GLD, which is the gold ETF. We could play GDX, which is the major metal miners, and they are often sort of levered to the upside, and they've actually underperformed the metal, so we're going to take a look at that. Or we could try to pick, a single name that happens to have exposure, like a Wheaton Precious Metals or something like that, which is one of the silver miners. Let's just start with SLV first and take a look at how we can make a bullish bet there. We'll then move on to GLD. We'll then move on to GDX, to the major miners, and then if we have a little bit of time, we can take a look at a single stock as well. Okay, so things that are going to be of interest to me in this. The direction. We've already chosen a direction. We're bullish. So that makes that part pretty easy. And if you happen to be using the OptionPlay app, which I know many of you do, you'll notice that as it happens, the technical setup here is positive. So the next thing I'm going to be interested in is how are options priced relative to how much the underlying is moving around. And the answer to that question is that it actually is quite fairly priced. So right now, if I'm looking at 3-month at the money implied volatility, so that's the price of options going out, it actually hit recently, those 3-month options recently hit a low of almost 20 implied vol. It's higher now, but not much. And just a quick point. Some people will believe that, as the price of an underlying asset rises, that implied volatility falls. That's not always true, and it's definitely not always true where commodities are concerned. So the bid can oftentimes be to the call side rather than the put side. And if that's true, then one thing we can take a look at are using things like call spreads. So right here, if we take a look at the app, I'm just going to quickly hit this modify button, but I'm looking out to, in this case, May, which is a little more than 60 days away. I'm choosing an at or even slightly in the money call option. Remember, you're going to try to execute these things at using limit prices and stuff like that. That's really important. So use the app, try to figure out roughly where the mid-market prices are, and you can choose a slightly in the money option or slightly out of the money option. I generally like to choose a slightly out of the money option. Quick point about the trade-offs here. If you use an out of the money option, you are going to reduce your probability of profit. And the reason is because the underlying asset has to get through that strike price by more than what you're paying. So you're reducing the cost of the spread, but you're raising the strike. And if you're going up by, dollars in terms of the strike, but only coming down by smaller increments with respect to the premium you spend, you're going to lower the probability because that break even is moving higher up. But the reason I like to do that is because The whole idea, to me at least, of taking long options bet is to get a little bit of convexity. And I'm going to kind of lose that bend, that curve that you're seeing right here. That's the benefit that I'm essentially trying to capture. Now, by the way, when I'm using spreads in general, I usually don't want to go too much further out than this. And the reason for that is that this payout chart that you see, that you're going to get, is only at expiration. In between, instantaneously, it's this curve that represents the payout you're going to have. So if I buy this spread, which in the example I'm providing is the May 23-25 call spread, this is a $2 call spread. I'm going to be spending just over 25% of the distance between the strikes. So it's $2, paying 54 cents for that, $54, because each contract, as we'll remember, represents 100 shares. To me, I think this is, a way that you can make a bullish bet in silver. You can do something very similar in GLD. So let's take a look at that. And you'll notice that in this particular case, it's already defaulting that. Not surprising that the technical setup is very similar. So same thing here. This is actually going to default to an in-the-money strike, but I like to look for something that's just a little bit further out of the money. And I want to just make sure that I'm getting a decent percentage of the premium that I'm spending on this option that I'm buying by selling the other one. Because if I'm going to get, I'm paying $3.50 for an option, if I'm going to get 35 cents, one could say the juice isn't worth the squeeze, you could say. But if I'm offsetting, call it a third or more of the premium I'm spending, that's going to be pretty good. Now, bear in mind also that when it comes to decay, options that are closer to expiration will decay more quickly. Those wing options will also tend to decay a little bit more quickly as well. So even though the total amount of extrinsic premium that you're going to collect is obviously much less than you're spending on the option you're purchasing, it is actually a meaningful offset in the meantime. So GLD, May 205, 215 call spread, we'd be paying 225 for that one. Once again, you can just sort of think about the distance between the strikes. In this case, it's $10, paying 2.25. So once again, spending a little bit less in this case than 25% of the distance between the strikes. Okay. So a lot of people who like to play in this space, though, prefer to look at the miners. And the logic for that is that the miners have operating leverage to the value of the commodity that they're producing. And so that's one of the reasons why you'll often hear people say things like, I'd rather buy GDX or I'd rather buy one of the miners because it's probably going to give me 2 for 1 what the underlying commodity will provide if it starts to rally. There is some truth to that, of course. There are some other meaningful things to think about, though, that play into it. For one thing, a lot of the miners, a lot of gold mines in particular, are in geographic locations that can be challenging geopolitically, shall we say. You're always subject potentially to the risk that somebody decides to confiscate it, or you have some other kind of operational challenges that exist there. The other thing is this is a very capital intensive business. So it is possible, and sometimes it is what you see, that your operational costs, your expenses, actually rise with inflation or faster than. So for example, fuel and shipping and every other potential expense rises more quickly than the commodity that you sell. And of course, you need to be successful in mining it as well. So your production is also going to matter. Now, this is an instance where, because of these factors, it is not uncommon for the miners to actually trade with options premia or an implied volatility that could potentially exceed the underlying, that of the underlying commodity. So here it can be even more important to use spreads than it might be in another instance. Right now they're tracking, to put things in perspective, what I was just talking about. this leverage, how the miners are levered to the underlying, we can actually sort of see that here. So GDX, we can see that that's the one that I just highlighted. That's the price of 3-month options in GDX. That's the miners. There's 2 different axes here. So it's the axes on the right that you're looking at for that one. So this thing is trading around 31 vol. So that's how much those options are. And then if we take a look at GLD, that's trading at 12. So you probably noticed that when we were looking at these call spreads that you're looking at a $200 instrument in GLD per share. And you can buy a $10 at-the-money call spread that expires in 65 days, and it only costs 1% of the cost of the underlying asset. So this is kind of the trade-off that you're going to get. And I just want to make sure that everybody understands that there aren't really any free lunches to be had from an options point of view, because options traders will recognize, look, the volatility of this underlying asset is far greater. The options premium will be commensurately so. So GDX options are going to be more expensive. So why would we look, though, to GDX rather than GLD if it doesn't seem like you can really take advantage of a big distinction in the options prices? And the answer to that can be found in the relative performance of the miners to the metal. And what we're going to see here, I'm just going to throw this in so we can just compare them. What we're going to see is that if we take a look at this, that gold has, over the course of the last year, outperformed the miners quite considerably, right? So remember that you're sort of expecting to get more leverage to the upside, that when the metal rallies, you kind of expect to get a benefit in the miners, and I told you some reasons why that won't always be the case. But here what we can see is that the metal has actually outperformed the miners by about 10%. So part of what you would be doing by deciding to get long the miners rather than the metal is playing for a bit of catch-up in that trade. And if you're wondering how much catch-up you're talking about, if we go back much, much further, so now I'm looking at this going back for 5 years, what you can see is that the miners have been all but dead money. Gold is up 63%, 64% or so over the course of the last 5 years or so. Okay, so now that we've sort of said, okay, well, we like precious metals, we like silver. By the way, one other quick point about the miners that I should also point out, and that is that they'll frequently have exposure to, not just one of the metals. A lot of the miners have exposure to several commodities. It might be gold as well as copper and so on. We can talk about the biggest constituent stocks in this index if we like. The largest one, which probably everybody is familiar with, is Newmont. Barrick Gold, obviously, is right in the mix, but we can actually see, if we chose to, we can just go take a look and say, okay, well, how much money is Newmont making from the various metals? And I mentioned Wheaton, for example, is a silver play, but we can sort of get a sense of what these guys are doing and sort of understand what their potential exposures are. And you can look by segment and see essentially what they're doing. So obviously they have significant exposure to gold and significantly less in this case to copper and silver, but other miners are going to have more exposure to these other metals. And consequently, getting long GDX sort of gives you exposure to the space without necessarily making a bet on just one single commodity. So looking at GDX now, I'm going to pull that one up and look for a very similar structure. Now, remember, the options are, as a percentage of the underlying asset here, considerably more expensive than they are with these commodities. If, for whatever reason, the miners were to continue to underperform, then you're going to feel like, okay, well, I'm spending too much. But the idea here is that they're actually going to potentially catch a bid. And we can actually see that we're starting to get some action now. At long last. And this is a way that we can get some upside exposure to GDX this is an important point too, by the way, I think, and that is that it's very easy to identify things that we think are undervalued. I could look at miners at any point for years now and say, well, it's underperformed the metal, so therefore I'm going to wait to, try to do that catch-up trade. And you would have been punished many, many times for that had you done it. So to me, what you're really looking for when you're going to do a trade like this is you are looking, essentially, I don't want to be the first money in. That's catching the falling knife. So I'm waiting for a situation where I start to see a meaningful move in the chosen direction. I want other investors to tell me that they're on board with this. Yeah, I could carry the idea around with me for days, weeks, months, or years before I think it's actually sensible to start allocating capital to it, because if nobody else sees it, if you're the only one, it's not going to do what you want. Are we going to be chasing it here a little bit? The fact that the stock has, the ETF has caught a significant bid of late? Yes, but actually I want to see that. And we've sort of broken through that resistance level. So here again, just going out to May, choosing that first out of the money strike, 31.35. Again, I'm getting a third of the premium spent on this thing for this. And once again, I'm spending about 25% of the distance of between the strikes, 97 cents. That's the kind of math payoff that I like. Again, for spreads of this type, I don't like to go out more than 60, 70 days, simply because, as I pointed out earlier, the payoff you're going to get is this shape instantaneously. So you put this trade on tomorrow, the P&L that you're going to get instantaneously is going to follow this curve, not that expiration type of graph. Okay, so hopefully we have some tradable ideas coming out of this, which I think is really quite important. So with that, I'm going to try to take some questions, and I definitely want to take a question because one of them is about GLD. Hi, Mike. My poor man's covered call on GLD short leg expires March 28th. Do I worry about rolling it until 7 days prior? Okay, so I know what the expiration for this one is. I don't know what the strike is. Let's address the strike part first. Okay, and actually one other quick point. As I said, I think GLD options are very fairly priced here. And when they're fairly priced, that means that there's not a particular amount of edge to be had by selling them. The whole idea with selling options repeatedly to collect premium by doing things like covered calls, which is a fine strategy, but the idea is that you are trying to collect a risk premium, specifically the volatility risk premium that is built into the insurance aspect of options prices. And I think that's a little bit of a challenge. When you're going to cover, whether, if you have a short option, if it gets to more than 60 delta, so that means it's going to be in the money, that's when I start to think about adjusting, rolling, or covering. Now, in this particular case, what we had is, GLD had essentially topped out around, 192.5 or something like that for the past year or so. And then we had this sharp upside move. When you see that, to me, that if you were trying to do a range-bound thesis, which covered calls are by their very nature, so in a covered call situation, you're limiting how much you can make to the upside, but because you have some exposure to the underlying asset, you're exposed to the downside. So by definition, the thesis is, or it should be, a fairly neutral one. And I think we had a little bit of a breakout here. So 60 delta, I'd probably think about covering it. Okay. I just got an update on that. So the strike is 189. So actually, let's take a look at that. Let's see what those options look like. Oops. Got to type the ticker correctly. All right, so GLD, March 28th. And now I'm just going to use this so we can sort of get a quick and dirty look at what the price is. So these were, what did I just find out these were? The 189s? Is that right? 189, okay. So these things are, well now, effectively, these things are just stock, right? So this is a, if we're looking at the app right here, this is the delta over here on the right. So this is 95. This has effectively become stock. April 188s are your long leg. Okay, so let's add that. So we're going to sell this. We're going to add the April, I assume April regulars. Don't know where you initiated this trade. Now, actually, one quick point. This is a diagonal. When you put on diagonals, if you buy a longer dated call option and then you sell a near dated higher strike option against it, if you spend less than the distance between those strikes to initiate that trade, which is going to be hard in a low volatility instrument like GLD. But if you did, you do not get into a situation where you're just targeting that short strike, which in a calendar spread or a butterfly or something like that is typically what you're trying to do. You're trying to get it run right to that short strike. If you have a diagonal and you pay less than the distance between the strikes, you have a situation where, yes, your peak profits are going to take place at that short option, but no matter how high it goes, you're not going to lose money. And I think that's an important thing to think about because, as I described in an earlier live stream, one of the most painful things for a trader is to be right on the direction but wrong on the trade. Okay, so just about that very quickly. So what is important is to analyze your position as of the current prices. And actually, you know what? Let me just make sure I have this mid thing tricked on because I just want to make sure that we're looking at this correctly. Okay, so this is the characteristic of the trade as you have it right now. So one thing about the trade, it can't really lose if you have lost, because I don't know what prices you put it on. It can't lose anymore, really. So that's the good news. What's the bad news? Because we like those types of trades, right? If you're in a position and it can only make money from here, that's the good news. The bad news is where it makes the money. And where it makes the money is lower. And that's not really our underpinning thesis. So there isn't much harm, it should be said, in holding this trade and then looking to make sure that you cover these. You're not going to get assigned. There's not really any reason for somebody to exercise those calls early, those March 28th 189s that you're short. And the reason there isn't, because the reason you would do that is to collect a dividend. GLD doesn't pay one, so that's not really a concern. So the good news is, can't really lose more. Bad news is, it's not really the direction we've chosen. Okay, I hope that helps. Ranjana Gupta asks, I bought ADM, Archer, Daniels, Midland at 79. It's now 59. Should I keep writing covered calls on it with strikes well below my purchase price? I want to keep making money. Everybody wants to keep making money. Why wouldn't they? So for those of you who don't know, very interesting situation in ADM. And, I was going to try to play this one into earnings, or at least it was on my radar to do so. What happened here? So why don't we take a look at a chart of it? I have one up on one of my screens. So here's Archer Daniels Midland. This is Archer Daniels Midland over the course of the last year. What's this all about? So they just announced earnings, but what's this all about where my cursor is right here? Two of the words that will put the fear into any investor on the long side, if any two will. How about accounting irregularities? That's really what the concern was. CFO has been suspended here. I thought about actually buying this going into earnings because the option sentiment looked very positive. Really wish I had, because actually the stock did catch a good bid. They just reported. So I was actually looking at this thing earlier today because I was thinking, wow, what an unfortunate miss that was. Had an opportunity to buy the stock, was thinking about it. It's up 10%. I was thinking about it. It's probably 8-9 trading days ago. So we can see it's up about almost 10% since I was taking a look at it. The reason I did not do that was when I was looking at it, the company promised that they were going to try to meet, so they got an extension to release their financials. And that makes good sense, right? So if you're a publicly traded company, you think that there might be something going on with the financials, you suspend your CFO. You cannot then just come out and do your quarterly earnings results the way you normally would, because all of the data that you're relying on is now suspect. So they asked for an extension, which was granted, and they were going to try to work through the information as absolutely positively quickly as they could. And in my experience, accounting irregularities rarely turn out to be very good news. So I had and also, when you have some situation where there is something that you have to restate, for example, the people who are going to be doing the restating it aren't the ones usually that were responsible for putting that information out in the first place. So the most common thing for them to do is what we call kitchen sinking it, which is they just sort of look through and say, okay, what's all the bad news we can find? Let's just get all of that out into the open and throw it out there. We'll get somebody else in charge of the situation. And as we go forward, we sort of have a clean slate, nice fresh plate. So it's not that common that you expect that first sort of bit of financial information that comes out of this kind of thing is going to be positive. It turns out it actually wasn't so bad. And that's one of the reasons that the stock didn't get flushed on earnings. Where does that leave somebody who holds the stock now? Well, I actually think that if you intend to hold the stock for a long period of time, what you probably should be doing is continuing to sell calls, because I don't think that overhang has completely left it. That's the first thing I would say. The second thing I would say is that options premiums are not going to go to zero in a situation like this, because, again, people are still waiting for more uncertainty, and that risk is going to be built into the options premium. So that's the good news for the covered call writer. What's the bad news? Well, the bad news is that this is the supermarket to the world. This is not the world's sexiest business. We're not dealing with GPUs like NVIDIA or something like that. So this stock doesn't move around that much. It doesn't move around that much. That means the options don't have that much premium built into it. So if the implied options premium for, the implied volatility is about 20% annualized, even if you're just selling, weekly options, for example, against it. So this is a name that has weeklies. It's something that we look at. What are you going to get on a weekly basis? Even if you sold the at-the-money calls, 1%. That's what that straddle is going to cost. That at-the-money straddle going out about 7 calendar days, 5 trading days is going to be about 2 to 2.5% of the current stock price. So I think it's fine to sell some premium around it. I don't really see the stock recovering that lost ground very quickly. Okay, let's see what we have next here. Mike, can you explain how market makers use stock to hedge their options positions? Delta hedging. Okay, so delta is the rate of change for the price of an option with respect to changes in the price of the underlying asset. Usually this is expressed as a percentage. So for calls, because calls are obviously going to go up in value as the stock goes up. So if they're way out of the money, underlying stock prices changes don't really do anything. So the delta is 0. And if they're deeply in the money, then they're going to behave like stock. So the delta is 1 or 100%. So when a market maker is trading options, I was a market maker for a long time, both upstairs and down. So the way that works, somebody comes in, they, let's just say we were looking at ADM as an example. Might as well look at ADM, why not? And you know what, I'm going to put it into options. I think it's a little more visible in there. than on my Bloomberg terminal. Let's have a peek. Okay, so obviously the sentiment in ADM bearish, not surprising given how badly that stock's been beaten up. Okay, so you go out to May, looking at the 57.5s. That's basically an at-the-money option. I can already tell you that's going to be 50 delta, slightly above because it's very slightly in the money. But let's just say you're going to take a look at like the 65 strike option. Okay, so that's out of the money. That is a 23 delta option. Remember, that's the number right over here if you're looking at this. But if on your broker platform, whatever trading software you use, heck, you could probably just Google it and it'll tell you what the delta is, instantaneously what the delta is at any moment in time. So somebody comes in, they say, how would this have gone down? They would have said, ADM, May 65 calls, how are you? That means they're basically asking me for price, and I would say, I'm 90 bid at $110, 500 up. Okay, I'll buy 500 at 110. So fair value on this thing's call it 95 cents. So I sell 500 at 110. Each options contract represents 100 shares. So 500 calls times 100 is 50,000 shares, but I don't need to buy 50,000 shares to hedge. I need to buy 23% of that number, right? So 20% of the, so first things first, I know it's a 20 delta option. I'm going to buy 10,000. I have, I have just another 3 deltas here. So 21,500, 21,000, 11,500 shares of stock. That's how they do it. That's at the moment that they trade it. Now, what the options traders are doing next depends on whether they bought or sold the option, because the delta also changes. As the stock price goes up, the delta goes up. So I would actually need to buy more stock. If the stock runs all the way up to 65, that's basically a 50 delta option. I hedged it on a 23. I'm going to have to buy more stock because I sold 500. I know I need to be long 25,000 shares. That's 50 delta at 65. So all the way from the current stock price, which is whatever the current stock price is, it closed 58.27. So from 58 to 27, to hedge my changing delta exposure, I'm going to be buying more stock until I own about 25,000 shares at 65. If the stock falls, I have to do the opposite. So what does this mean? Well, maybe it means nothing to you, but it can mean something, and that is that if there's enough exposure from market participants who are trying to hedge, they can actually have an impact on the stock price. Now, the types of hedging I just described, buying 11,500 shares, that's not going to do a thing to this. This thing traded 14 million shares today. And if I had to buy another 10,000 as it rose up to 65, that 10,000 shares isn't going to have any impact either. But if this didn't trade a whole lot, and if I traded more than 500, or if you're just looking at the aggregate of all of the market makers, it's possible that they can actually exaggerate those moves when they are short the options. Because when you're short, that means you have to buy stock on the way up, and you have to sell it on the way down, and buying it can cause more buying, and it's reflexive. Contrarily, if I was long the option, so our covered call guy comes in, he sells me these calls, I actually have to buy stock as it falls, and I have to sell stock as it rises, because my hedge ratio is actually working for me in that case. So when options market makers, if they have a huge amount of open interest, they can exacerbate volatility when they have to chase stocks up and chase them down, and they can compress volatility when the opposite takes place. Okay, let's see what is next here. Let's see. J-Bow, hi Mike, U.S. steel was down 12% today on news of the White House may have concerns about its merger with Japan Steel. I have to look at this a little bit more carefully because I have to see what the rest of it is. Is a double diagonal strategy. Selling the March 2238 put, 44 call, long May 1740 put, and the 42 strike call. Okay, So it's interesting when people talk about option spreads and the terms that you use to describe them, that it can get a little bit confusing. There's a couple different ways you can think about this. So, double diagonal, is it inaccurate to call it a double diagonal? No, you're doing two diagonal spreads here. Is it inaccurate to describe it as a strangle swap because you are selling a nearer dated strangle and buying a longer dated one? No, that is also a reasonable way to describe it. Who cares? It's an option spread. Let's just take a look at what the payoff of that spread would be. So first of all, we're talking about US Steel, so we're just going to load this thing up and take a look at this. So what he is doing in this trade is selling the March 22nd expiration, 38.44. I think I have that right. Yep. So I'm just going to put these in. What the heck? So bear with me. Shouldn't take too long. March 22nd. So selling the 38 strike put. And selling the 44 strike calls. By the way, somebody asked me recently, they said, do you have access to all these tools? Do you use... This is one of the reasons why I like to use tools like OptionPlay, because if I tried to build this thing out and get a quick look at it in Bloomberg, it'd be a royal pain in, well, you know what. Okay, so let's take a look here. So we're going to buy May, and I'm assuming, so Jay, for what it's worth, and maybe you want to update us on this, I'm assuming you mean buying this strategy. So you are going to be buying the May 40 puts, and you're going to be buying the May 42 calls. So let's take a look at how this is going to behave. So I've got, did I do that right? No, I didn't. This is supposed to be a call. That's supposed to be a put. And that's supposed to be a call. There we go. Voila. Okay. This, by the way, this payoff shape, where you sort of find that the peak payoff is essentially at the short strike to the upside and the short strike to the downside, with a little bit more to the upside than the downside, is about right. First of all, the value of an option is a function of, among other things, the strike. So all else equal, the same implied volatility, a higher strike option is going to be worth more when it's at the money than a lower strike option would be at the money, same time to expiration, same implied volatility. It's just the math. Okay, so do I like these types of trades generally? Well, yes, absolutely. I love them. And the reason is because it is a way for me to try to capture some elevated theta or decay before expiration. What are the considerations, though? And there are some important ones we want to think about. So what are the things that we want to think about in no particular order? Events, like earnings. Anything that could move the stock in the meantime can have an impact. And so in the case of United Steel, they have a general meeting on April 12th. It's going to be 1 o'clock in the afternoon. And they're going to be, this is an estimate, so follow their investor relations page just to be sure. They're going to be reporting earnings on April 26th. Why is this important? Because the options that you're buying, which are in May, capture that event, and the options that you are selling do not. So we like to do that. Please bear in mind that the instant an event takes place, if you have options that expire well beyond that, you're going to get something that some people call a vol suck or a vol crush. And the implied volatility of those options can drop significantly. So you can have a step change in the price of those options, even if the stock doesn't move, because there's a bid to insurance premium before an event, and that goes away once it comes and goes. It's like selling in, hurricane insurance right before the storm hits. Well, guess what? Gets a lot cheaper after it's come and gone, because we already know what was going to happen. So the next question we want to ask ourselves is, what is the price of the options that I am selling versus the price of the ones that I am buying? And perhaps we can share my Bloomberg screen for this, not because it's the only way to look at it, but I think it's kind of interesting and a way to illustrate it. So this is the price of US steel at the money options. And the truth is, if I was trying to be precise about this, I would actually choose something close to the strikes that are involved, which are up and down, call it 5%. You know, what the heck? Why am I saying this is what we could do? Why don't I just show it? Okay. So these are the two term structures. Okay. Implied volatility of the, oops, this is not correct because that was, I want these from today. Okay. So this is the 5% out of the money, strikes to the upside and the downside. You are buying May, that's over here, and you are selling the expiration on the 22nd, that's over here. Notice how this is downward sloping. So this is the implied volatility or the price of options that expire soon. These are the longer dated ones. Remember that these Mays capture earnings, which I mentioned are going to be reported in April. I like this trade. Those Mays are not going to, they're not going to lose a whole lot of premium at this point. Now, where do you want to adjust this thing though? So good trade, absolutely like it. You're catching a bid in these near dated vols because of this event. So that's one of the reasons why it sets up this way. Once this sort of sorts itself out, that's likely to come down. And the interesting thing too is that imagine that there is some kind of antitrust concern. What are the chances that that antitrust concern is going to be resolved within the next couple of weeks between now and the 22nd? So we've got 15th expiration, so we're actually only going out about 10 days. Are we going to get an answer within 10 days? Yeah, I doubt it. So do I like the trade? Yeah, good trade. Let's see what else we got. Okay, I see, I don't know. I see someone else say, I just closed out an SLV credit put spread today. All right. This is actually kind of an important point too. A credit put spread and so a put spread, if you sell a put spread or you buy a call spread, those are basically the same trade. But if you sell a credit put spread, of course, time is on your side. If you buy a debit call spread, time is not on your side. But if they are the same strike and same expiration, they're going to be remarkably similar. I think this is not intuitive to a lot of people, so what the heck? Why don't we just illustrate this? One is a synthetic equivalent functionally of the other. It's obviously somewhat different assignment issues and things like that. But let's just put this in. So I'm just going to go out to May here. On one side, I'm just going to build a long call spread. So in this case, I'm going to buy the long 22, 24, whatever. It doesn't actually matter which one I do. So here's our call spread. That's our payoff. And let's build a put spread, same expiration, credit in this case. So we're going to sell the higher strike put. We're going to buy the lower strike put. And in this case, I'm just going to once again make it just out of the money. So because this is the way it would be more frequently put on, so maybe I'll make the 21.19. So I'm selling the 21. I'm buying the 19. Or maybe I'll make it the 22. Let's go up a little bit higher, whatever. All right. So now take a look at this. Very similar shape. This one you are collecting a small amount and could potentially lose a lot if it moves. The other situation, the opposite is true. You're spending less to do that. But take a look at what happens if these two expiring on the same day are the same strikes. So I'm just going to use, again, to keep things simple, I'm just going to make this the 22.24. So that's that. I'm going to make this the 20. Did I say 22.24 or 20? 20, sorry. 20. 20.24. Notice anything? Look at that trade. It looks an awful lot like that trade. Why? Because they're synthetically equivalent. So selling credit put spreads is a way to essentially make a similar directional bet but trying to collect relatively small amounts of money and improve your probability of profit. Buying out of the money call spreads in this example, you're spending less to make more, but you're decreasing your probability of profit. So you can take those two strikes and move them up so that they're both out of the money, down so that one's in the money, one's not, or so that they're both out of the money to the downside. And essentially what you're doing is you're turning it from a trade that pays you over time to one that you pay for over time. The one that you pay for obviously gets a better payoff. So in the examples where I keep saying you spend 25% of the distance between the strikes, so on a $2 spread you spend 50 cents, the payoff is 3 to 1 if you get it right, but the probability is lower. If the person who takes the other side of that trade is getting, they're going to pay 3 if they lose to collect 1 if they don't, but their probability of profit is higher. To me, once you think something is moving, though, so if you think something's not going anywhere or you think it's range bound, I like credit spreads. And actually, credit spreads in SLV and the miners has been probably a pretty good trade. Every time they dip a little bit, because they've been range bound, they've been stuck, the premium was high. Fine, sell put spreads on dips, sell call spreads on rips. But once you get that breakout, I don't think selling premium is the way to go. Let's see what else we got here. JP Morgan. Okay, JP Morgan's going to be the first name to report on the next earnings cycle. I currently have JP Morgan April 19th, 175 calls that I bought for 640 and added April 19th, 185 calls just recently for 740. Both are in profit. Let's have a look here. JP Morgan. Okay, so of the money center banks, I like JP Morgan best. I am not unique in this. Why do I like JP Morgan better, actually? And I think that's a fair question, because it's not like if all you had to do was sort of look at their book value, that it would necessarily, that the first thing you would think about was that, it's such a great bargain compared to the other money center banks. Why do I like JP Morgan? Well, there's a couple of reasons. One, JP Morgan relative to the other money center banks, and in that case I'm talking about Citibank, Wells Fargo. They have exposure, much better exposure to things like sales, trading, investment banking. They're preeminent in that space. No offense to the others, but they're not as well thought of in those areas. Look, I mean, it's the numbers are there. They are not in the same league with on the investment banking side with let's say Goldman and JP Morgan. Some other banks do have other strengths. Morgan Stanley has pivoted their business model, somewhat less investment banking, less sales and trading, more asset management, which has its own strengths and weaknesses. But okay, what do we got here? So April, 175 calls. And he's actually added both of these. So I'm just going to go back to April expiration. So he owns the 175 calls. And yes, they are both certainly profitable. And then he also bought the 185 calls. So just a quick point about this. Interesting. So you bought calls, the stock rallied, and you bought more calls. What's good about this? Well, one of the things I like about it is that you're pressing a bullish bet. One of the guys I used to work for at Ivory, the guy I worked for at Ivory, he was a portfolio manager. When he had a trade that he was building conviction in, he was not afraid to throw more money at it. And he was definitely very successful as a result of that. However, the one thing I would say is that, you own in the money call options, you're losing the benefit that options provide, that sort of bend, that hedge, because this is going to behave very much like stock at this point. Effectively, what you synthetically have is your long stock and you have puts for protection. That's what that is. So it's synthetically the same thing. With the exception that Yeah, so I mean, I will typically look to roll my long options up when they get over 60 delta, just like I look to close options that are on the wrong side. 60 delta is kind of a number that I look to. Everybody can have a different thing. On the long side, my idea is that I like to own, say, 30 delta options on an anticipated large move. The idea being that I'm getting some gearing, I'm going to get some benefit, and also I'm mitigating my downside risk if I have the thing wrong. So once that thing starts to trade like stock, it's not an option anymore. It's basically a stock. So I would consider as an alternative when you have situations like this, when you bought these next higher strike options, you were essentially rolling up, except that you didn't roll because you kept your old position on. You can roll up or you can roll up and out. And if I feel like I have a trade that's working my way, I will often do that. If my conviction has risen and I think we're about to really get on the cusp of a big move, then I might redeploy all the capital. But in many instances, what you might find is that you can actually take the money that you put on to the trade off the table, and you can buy as many or more longer dated options to the upside and still keep a little bit. So you're almost playing usually with some of your money and some of the house money, but that's just one way I would like to look at it. Let's see here. Mike, what do you see in people hedging gold rally by shorting silver? Well, I guess this kind of depends on what their view is. If your view is that precious metals are going to catch a bid, and maybe gold rallied first, and so you're thinking that silver could potentially catch up. I don't know. I mean, if you're hedging one with the other, then you're sort of taking a lot out of the bet, I would say. You're trying to ride a secular trend. And if that secular trend is that precious metals are going to increase in value, and now you're going to split hairs by saying I'm going to buy one and short the other as a hedge against it, kind of less crazy about that, because now you've got to get a couple things right. And I think that's a little bit of a struggle. I've always, it's interesting. At the hedge fund, it was a long-short hedge fund, and the idea was you always bought the best name in the space and shorted the weakest name in the space, capitalizing on superior intelligence, superior research. We have a better idea. We generate alpha because I figured out that Tesla is better than Rivian, so I'm going to buy Tesla and I'm going to short Rivian. And I've really analyzed the market, and that's where my edge is found. Okay, maybe that's true, maybe it isn't. But if you're talking about a secular trend where inflation is going to make a play on precious metals, and now you're going to try to handicap which one's going to get affected more by this, maybe you get that right, but maybe you get it wrong. I'd rather just say, look, you have a diversified book. You probably own, a lot of tech stocks. Probably, like most people, you probably own more tech stocks than anything else. If you're going to make a play that precious metals are going to rally, just pick the one you like and get long one or both. I kind of prefer that to shorting it, because if you're going to really try to make money on a secular trend, you kind of have to let it ride. That's just a reality. We already are coming up with a hedge, by the way, simply by doing spreads. What else are we doing? We're chewing up the clock. My God, how did it take so? I'm very long-winded. I apologize for that. When would you suggest? I'm going to make this the last question because I realize I've taken up a lot of your time, and those of you who've stuck around have been very patient. When would you suggest rolling June 2114 calls for gold to take some money off the table? GOLD. Okay, so let's take a look at this one. Not to be confused with GLD, which is the ETF. This is, in fact, one of the miners. So, interesting. Once again, we're dealing with some fairly deep in the money call options. So the 14s, June 14 options. Let's just take a quick peek. My guess is that those have reached a delta threshold where I would say maybe you take that. Those are 85 delta. I probably would have rolled those already up. Because you're out to June, I probably wouldn't have gone out. I just would have gone up. But that would be something just to look at. Once they start getting the money. I want to give some credit, by the way, to both our trader in JP Morgan and GOLD. An important point, most traders take their profits too early and they don't cut their losses early enough. You guys bought calls. I assume they were out of the money when you did it, and you rode them. So good for you. That takes some discipline. But what also takes some discipline is knowing that you can probably get a little bit more gearing out of your trade if you're a little bit more nimble. But who am I to criticize? Because you guys have done a very nice job there. Folks, thank you very much for watching. There may be an affiliate link down below, which I encourage you to look. Please like, subscribe. That's very helpful for us. And please join me for the next one, which we're going to be doing on Monday, 4:15 after the close. Thanks for watching.